Good morning. Welcome to another What's Up with the Market, market status update. Haven't done one of these, I think, for 5 weeks. We've been bringing you other presentations on Wednesdays, Dave and myself. And last week, I did a secular bull market update. Now, if you haven't seen that, I'd suggest you do, because that provides a big picture update. I did that last week, but the last one I did was December, and there'd been some changes since then, and just some confirmations as well. So this, and the reason I say that is that this session is provided in the context of that really big picture. So this market status update that I do, which I'm going to do monthly now, is really a microcosm. It's the micro of the macro, if you like, Mark Douglas terms. Anyway, let's get into this session. Before I do it, I have to remind you that none of this analysis that I use here is used in SPA3 Investor or SPA3 Trader. It also is, I don't use it in any of the public portfolios. That is the US and ASX real money portfolios that I maintain and that you can download in your instance of Beyond Charts. I use none of this in my own personal portfolios either. I'm a 100% mechanical trader, active investor, and I precisely follow our systems. It's the only way that I engage the market is with the same systems that our customers use. And everything we cover here today, because we will be looking at up-to-date daily data, is general investment advice. It's not specific or personal investment advice. Right, without much ado, let's get into the Dow Jones and start looking at the analysis. Right, move to chat quickly to see if any questions come up. Starting with the Dow Jones, it's in high market risk according to SPA3 Investor. And just zooming in over here, you can see that the Dow Jones did make a new all-time high on Friday the 30th. New all-time high and all-time high, close and high. And then we led into what happened in the US today, a bit of a big down day. But it's from a swing chart perspective, if I had to put a swing chart up here, you'd see there was a new swing high there, and we haven't had a swing low yet. So that's positive in the very short term using swing chart analysis and higher highs and higher lows. But that is a pretty big day, big down day. And we also do have a sell signal as the last signal that we had on SPA3 Investor looking at the chart. The other thing to look at down here, and I could put a trend line in here, is that the Dow Jones is outperforming the S&P 500. That's what that is. This is. It's a relative strength chart between the Dow Jones and the S&P 500. So slight outperformance, which typically tells you about, it gives you the analysis, the interpretation of that is that this is a risk off market, is that that typically happens when the market's going through a bit of a weakness or weak period. So onto the S&P 500. First thing to note here, this is the last signal here was an entry signal. That's just different parameters that we have between the Dow Jones and the S&P 500. Volatility is picking up. We use the ATRVE. We use a 21-day ATRVE. Volatility has been higher. That's because of that drop there, and just picked up a little bit as well. It spends most of its time under 1%. That's its red line. That's 1% volatility, or using average true range. The S&P 500 did not make a new high. If we look at the swing chart here, it just failed to make a new high over there. That's a new high and a new high close as well. That's both. I'll just take this off to unclutter the chart. And so a little bit of weakness there and leading into a big down day. Both of these are within the trend. This trend has been set on both of them going back to the 2022 fall. It was, I think, a 25%, 24 point something percent drop in the S&P 500. So the context of this, relatively short to medium term, is that channel, that rising channel. So in the upper half of it, using that median line, but a down day. So nothing really untowards yet at this stage, but some early warning signs that there could be some more weakness. And guess what? We're coming into that famous triple witching period of September, October, which is renowned for being going through a bit of a challenge with the indices and stocks as well. Right, another chart we're looking at here is the cumulative new high and new lows, and there's divergence. So we've had the cumulative new low line is rising. There's put it over there, and we've had a lower high in the S&P 500. Sorry, this is the New York Stock Exchange. It's not quite the same as the S&P 500 because that's what we get the cumulative new high, new low indicator on. But there is divergence there. So, of course, not every divergence guarantees that there's going to be a fall, but typically you find before every fall there is divergence. So that's a little bit of a warning sign as well of some weakness to come. And if we go to the cumulative advanced decline line, also for the New York, which is 250 stocks, I believe, there's also divergence here. So that the cumulative advanced decline rising, meaning more stocks are going up than down, but the index failed to make a new high. So there's divergence there. Also an early warning signal. If we go to the number of stocks in the S&P 500 above their 150-day moving average, that's not divergence because they are both dropping, but there's weakness. That's a display of some weakness that the number of stocks couldn't make a new high there, and we know the index didn't make a new high on the S&P 500. Not as clear a warning sign as divergence, but still showing some weakness. Right, on to the US dollar, which I use as a clear, as one of the most important indicators, if you like, of what may happen in the short term. US dollar, this is the US dollar index, which is a basket of 6 currencies, is rising. Index starting to fall over here. So that is where you'll find that when the S&P 500 is rising, the US dollar index is falling, and vice versa. If this continues to play out, i.e. the US dollar gets stronger relative to the S&P 500, small uptick over there, but you can see this has been the market's been outperforming the US dollar over some time. So we call that the US dollar versus stocks ratio. And you would see, if this continues rising, that we are going to see this Ciroc indicator, this trending indicator, which is an indicator of the ratio between the two, so an indicator of an indicator. And we'll see that start rising. It's a relatively medium-term indicator period setting I've got on there. You could make it a bit shorter if you wanted to, but I'm happy with that setting at that Ciroc, the periods that we've got in the Ciroc there. So not quite small indication there of US dollar rising, but we want to see that Ciroc rising as well. So growth versus value using the Russell 1000 is this signal came where growth was underperforming value back on the end of July, so some 5 weeks ago. And you can see it with the naked eye. That blue line falling over there means that growth is underperforming value, or value outperforming growth. And we got that coming through, the Ciroc indicator, trending indicator on the relative strength line. And you can also see it with the naked eye. You can see here that value is rising and growth is falling. That is also a risk-off indicator or sentiment indicator, if you like. And so another sign of weakness and potentially risk-off. Moving to discretionary versus staple, using the SPDR sector ETFs. Again, same thing. You can see here that discretionary is underperforming staple. There's staple rising, discretionary falling, shown out in the relative strength line. So that blue line tells us relatively what's happening between the two. When it's falling, discretionary is underperforming staple. And there we've got the Ciroc actually came to the party. What was that, on the 20th of August? So another risk-off sentiment indicator here as well. So these are starting to line up a bit. One that's not going in favor, although in the very short term, this is a long-term indicator. This is the put-call ratio on stocks on the whole S&P 500. This is actually an entry signal. When this falls, it means that calls are outdoing puts. And you can see there I put a trend line here on the lower lows, on the troughs, if you like, to give an indication. So when this is falling, that's good. It means there are more calls and puts. But we've just seen a higher high just in the short term over here, starting to get higher lows. And the 252-day simple moving average on the put call ratio line has not started rising yet, and we would see that come through. But so that's more of a longer term indicator than a shorter term indicator, that one. Right, looking at 10-year Treasury note yields, definitely in a downtrend, fell out the bottom of this channel on support over here, and even in the session that just closed, 10-year yield, Treasury note yields were down. So getting into 3.84, and they were getting up to 5 back here in about a year ago, September 2023. So are definitely lower. And this is a risk-on indication using 10-year Treasury note yields. And you can see that this trend over here, the relative strength between yields and equities has been falling, meaning equities, that's typically positive for equities. So that's one that counteracts all the bearish, the risk-off signs that we've seen so far. Right, moving to Treasury to bonds. This is a 20-year plus bond TLTs, the ETF that we're using here. And typically, because yields and equities go in opposite directions, is that you would have bonds and equities going in the same direction. And what I'm showing on this chart are the times when they don't. So nothing's 100% in the market or even in life. You can see that there are periods when they go against each other, contrary to each other, but they typically fall in. They typically go in the same direction. And what that usually means is that one or the other is going to drag the other in the direction that the other is going, but we don't know which one's going to drag which. So which one leads, and they do take turns in changing which is the lead, which one takes the lead. At the moment, you can see there is some divergence here where bonds. This is bonds are falling, stocks were rising a bit. So the question is, are equities now going to follow what's happening with bonds? Now, what you just saw in the other chart was that yields were actually in a downtrend, but there is just a little bit of an uptick over here. So the fact that they are slightly going in different directions with a little bit of different amount of range or volatility shows indecision, and this will resolve itself one way or the other, but too early to say which way. But so some confusion there between what's happening with bonds and yields and equities. But certainly is going to play out, and we'll do another one of these in a few weeks' time to see which way it goes. So there are signs, and there are not enough signs to make it conclusive to say that the market's going to follow these sentiment indicators or these technical indicators, if you like. So and also the breadth of market indicators that we've looked at. So certainly looking not as positive as it was a little while ago. And that's now come through in the VIX, the fear index, where we've seen a big rise, obviously with a big percentage fall, 3% on the NASDAQ and over 2% on the S&P 500. It's pretty typical. You're going to see that on a short-term period, short-term basis on the VIX as well. So that's followed through. Looking at some other sentiment indicators, firstly, just the raw analysis, price analysis on the NASDAQ failed to make a new high. Obviously, that's bearish. And we also got, from a relative strength perspective of the NASDAQ versus the S&P 500, also a sentiment indication as well. If the NASDAQ is outperforming the S&P 500, that's risk on, and vice versa, it's risk off. So what we're seeing here is, and this red line denotes that over there, which was 12th of August, as that line came up, the Ciroc actually started falling, it fell below 90, and you can also see it with the relative strength line here that's falling, is that this is a risk-off environment. The more volatile, if you like, the more risky stocks are not doing as well as the more stable stocks, being the S&P 500, and the S&P 500 is underperforming the Dow Jones as well, which is seen as probably of the equity indices, the more stable. So we've got the more stable, and we've also got discretionary underperforming the staple SPDR, and we've also got the value outperforming growth as well. So those are all, as from a sentiment perspective, all weighing up to being more of a risk-off than a risk-on market at this stage. But of course, we know these things can change pretty quickly. Looking at the NASDAQ 100, pretty similar to the NASDAQ composite, the broader index, and have failed to make a new high. Is also last signal, sell signal, same as with the Dow and same as with what we have on the NASDAQ composite. So this is looking more and more like risk off, but we don't use that with SPA3 investor. Certainly we do a SPA3 trader. So SPA3 trader NASDAQ would be 100% in cash at the moment and has been since the 25th of July, so about 5 weeks. Moving to cumulative new 52-week high, 52-week lows on the NASDAQ composite. Sorry, NASDAQ 100 is, there's the NASDAQ 100, fell there, but this is also falling, so no divergence there. So both confirming each other, which is also more bearish than bullish. And here we do have divergence with the cumulative advanced decline line on the NASDAQ 100, where we actually see higher peaks and higher peaks in the advanced decline line and lower peaks in the index, which is divergence, which is bearish. So this is a breadth of market indicator, is showing divergence. So as I said earlier, not every market fall not every divergence means that the market is going to fall, but what we do find is that just about every time the market does fall, there is divergence. So that's also a risk-off assessment there as well. There's no confirmation here of the number of stocks that are above their 150-day moving average, simple moving average, where they have both made lower peaks. There you can see the lower peak, lower peak, lower peak, lower peak. So falling, but not showing divergence. They're going in the same direction. The SOX, which is the semiconductor sector, is also showing weakness. The SOX eventually started falling here, 7th of August, and at the bottom of its channel, bottom half of its channel, and you can see the relative strength between the semiconductor index, which is the riskier of the more riskier index, being the NASDAQ 100, which we are relatively comparing it to, and it's underperforming the riskier sector of the riskier index is underperforming. So the sector is underperforming the index, and the index itself is the riskier index. So things aren't looking that good in the short to medium term. But remember, we do not predict. I do not use this to make any decisions in the public portfolios or my own portfolios for that matter. I'll follow the signals as they come. So this is not a market risk or a systemic risk measurement of what to do in the portfolio. We'll trade that mechanically using the signals themselves. Turning to the Australian market, just fell slightly shy of a new high there, but we have not had the 3-day swing down. That could be confirmed today, depending on how far it goes down. In which case, if that happens, if the 3-day swing is completed today, then this swing chart will draw a peak to the higher high, which was Monday's trading session, and that will be a lower peak. So we would have had a lower trough and lower peak, and which also doesn't augur that well for in the short to medium term. However, all of these indices are above their previous all-time highs, so we should start looking to support now. So the support, let me talk to that for a short period of time. Support should be where these zones are, and you'll see them on the charts. Some of these have zones that are above the all-time high. For the All Ords, the support here is the previous all-time high, which has found support plenty of times. And the more support, the more times it's touched on that as a support zone, which was a previous resistance zone, the stronger that support zone becomes. But it's not totally defensible. Like, we can fall back into the range. So what's likely here is that we are going to see a few days of some weakness in the market, drawdown in our portfolios, which is just absolutely normal for the market. So, and also what you're seeing here is what have I got here? 55-day moving average has not turned up yet, but you're starting to see a slight turn up of the All Ords outperforming the S&P 500, which typically happens in a risk-off environment. When the markets are going gangbusters, you'll find the S&P 500 outperforming the All Ordinary. So there's another little bit of a sign coming there as well. Onto the Aussie dollar, the Aussie battler, it has been showing some strength of late, but on the strength of the US dollar, the Aussie dollar fell, so some weakness there as well. Onto some of the international indices, Japan had this big fall, which we've seen in the other charts, And a lot of the markets have either totally recovered or nearly totally recovered the fall that we had. But Japan was where, which is where the fall was initiated, had the biggest fall as well. And we saw in absolute terms people talking about it. I just hated when particularly financial journalists talk in absolute terms, comparing to 40 years ago. It's just meaningless. It really is. The only way you normalize things, particularly when it comes to numbers, is the easiest way is through percentage movements, not absolute movements. And the same with dollars. Absolute dollars, $100 billion, 40 billion there, 50 billion there in a day, either up or down, is meaningless. It really is. And comparing that to, say, 1987, its percentage is the way you normalize things. So when you see absolute terms, just know that the journalist is either trying to be sensationalist or doesn't know what they're talking about. And both are just as bad as the other. One is just as bad as the other. So Japan hasn't quite got anywhere near the levels, and now there's a little bit of weakness coming in. That this here is the dotted black line I use as a previous all-time high, and that I've kind of, in my own analysis, excluded 1989. 1989 is where this black line is over here. So that is where the peak was reached in 1989. Above it, below it, above it, sharply below it. Found some support at the more recent all-time high, and now is testing this all-time high from back in 1989. So it's in confusion. There are big decision points that are happening in all the markets at the moment. But also remember that overlaid on this is September, October, which is just from a sentiment perspective on its own, in its own right, as a seasonal, if you like, indicator. It's typically a tougher period that we're going into now of the year. And so how do I play September, October? How do I view it? It's not always negative. Just depends on what happened in the context of leading into the period, which has been a little bit more positive than negative, and which really does play some role, not the entire role, in what happens in September and October. But what I look at here is how strong in a period of weakness does the market actually hold up. So how does it hold up? How does it react to this typically negative period? And what we do is not so much looking for gains, but how shallow or deep the troughs are that occur, the retracements that occur during this period. And of course, some people say, well, I'm just going to get out of the market, sell in May, go away, I'm getting out, September, October, I just get out. And there are people that do that, and sometimes they win and sometimes they lose. But the issue there is that is a discretionary call, and because we don't know what's going to happen, and of course anything can happen. And that is why we got to build, if you like, a regime, a mental regime, and a technical regime, a decision-making regime in our investing that actually keeps us consistent, not just to guess on a willy-nilly, one time I do this, another time I do that. Because that is the way that people make a decision to get out, and they go, phew, got out, and the market fell so much, but then they don't get back in. That's inconsistency. And of course, if the market takes off, and that is the far bigger mistake to make than to suffer some drawdown, is to not to get back in when the market rises again. So Japan, we'll keep an eye on Japan because it's where this dip started, and it was quite serious there, and we'll see how it recovers from here as well. Looking at the DAX, it made a new all-time high just a couple of sessions ago. Also the weakness overnight. There's its previous all-time high. I've put that in as a dotted line so far. In fact, I could actually now, technically, because we've had another high over here, raise that to there. I'm just trying to, just on the number of, and this is discretionary technical analysis, is formulate areas that are valid and genuine support and resistance zones. But to do that, you have to have enough touches to say, well, that warrants a previous high. That means that if the market gets through, either going in an up or down direction, that's more meaningful than another zone. So we can do that on the DAX, and we'll see how deep this retracement is there as well. FTSE above its all-time high, still an open trade, and we'll quickly look at Japan. At developing markets. Firstly, with the Bovespa, up above a new all-time high as well, and some weakness there, and also outperforming the S&P 500. In China, downtrend looks like it broke out of the channel. That's the top 50 stocks, but the wider market in China has been weak and continues to be weak and stays in that channel. Right, let's just quickly look at 3 other US indices. I did talk about the smaller, mid and smaller cap stocks. Looking at 3 indices here. One is the S&P 500 equal weight index, made a new all-time high on Friday's session, high close and high. You can see it above there. There's its previous high, and obviously not as far above the previous high or the same relative all-time high of the S&P 500 or the NASDAQ indices. But that's because the smaller cap stocks that are in the S&P 500 have been holding back the equal weighted index. But it has made that all-time high, wavering above and onto it and finding support at it, new all-time high, and then this weakness. So there is some strength there, and you can see, sorry, I should have put a green line over there, is that I won't do it now, but this is showing when the smaller mid-cap stocks come to the party, that is showing more market breadth, stronger market breadth in the market. And that is why we're looking at these indices now. We've been waiting for that for some time to happen, and it eventually came, and we'll see how that holds out. To see how it holds out, in fact, I'll just go to here and put on Spicer Investor, and you can see it is an open trade, Spicer Investor. And we'll also just quickly look at the swing chart here, and you can see it's made a new higher high. So that high is completed. Why? Because this bar over here completed the 3-day swing. So a day ago, that swing would not have been drawn. Add that onto it, and you now have the swing drawn. So that's a higher high, which is, and also is an open trade according to Spicer Investor, and therefore that is more of a bullish sign. And of course, what I was talking about is putting this Ciroc rising of the relative strength, the S&P 500 equal weighted, outperforming the S&P 500 is a positive. That's a risk on indicator. So that's kind of going counter to the other stuff we saw earlier. Right. Also the mid cap outperforming, starting to outperform over there, and then flattening out against the S&P 500. It's above its all-time high, and also from a chart. Let's go there. It's not quite an open trade yet. Didn't quite make a new all-time high, and you can see this indecision around the mid caps, as you also see around the small caps as well. So the small caps haven't made this. The S&P 600 haven't made a new all-time high. There's that line up there, but it is a risk on, and that hasn't turned yet. The relative strength going up and then falling and then flattening out against the S&P 500. So from a small cap perspective and a mid cap perspective and the S&P 500 equal weighted index, indecision there. You can see there's indecision, and trying to work out which way this market's going to go, because anything can happen. Right, let's just quickly go through commodities. The CRB index is not going anywhere. It's kind of just going sideways, but underperforming equities. Gold has made a new breakout to the upside. So there's the all-time high, strong out, consolidation with a rectangle, just equal high, equal. You can see that's probably a better place to draw that. And you can see a breakout, trend up, and into a sideways, which is strengthened, which is just consolidation, which is the market taking a breather and strengthening, and then a new breakout. So what we're looking at here is whether this falls back out of this trend line, out of this channel, and whether that all-time high zone over there is actually withstands the fall or not. But gold certainly bullish. Silver not keeping up, hasn't got anywhere near its all-time high yet, way up over there, and relatively speaking underperforming gold. What is that, since June, so since May of this year. So 3 months of underperformance there of silver versus gold. Weakness in copper, a few trading sessions outside of this downward trending channel, but back into the range, back into the channel, underperforming there. Obviously that leads into small cap stocks in Australia. Oil falling as well in a downward channel, lower highs, lower lows. And let's go to Bitcoin. So commodities not doing that well at the moment. And Bitcoin is in this long range trading. Typically the longer Bitcoin and cryptos range trade, the bigger the breakout to the upside or the downside. I have drawn a new support zone over here, just a temporary one. That's why it's dotted, weakish, if you like, because there's not enough touch points and not enough data to really give it authority. But there's the all-time high. Struggled, rushed up to it, went slightly above it, and the range did not extend. So now we are looking. This is indecision mode, and for a crypto, what does this go back to February? That's 6 months of indecision going sideways on the crypto. So wait for it. I don't know how many months it's going to go. We could go back and get an idea, but there's going to be a breakout. And the longer this consolidation, if you like, the sideways movement goes on, the bigger the breakout will be to the upside or the downside. And we can't predict which way it's going to be. Ethereum did not get to its all-time high, which is up there. So it's fallen. There's been relative weakness of it compared to the to Bitcoin, but also a similar thing, breakout, consolidation, fall back into a range below. So there's more weakness in Ethereum than what there is in Bitcoin. Looking at uranium, it's moved to the bottom of its channel. This is a weekly chart. There's quite a long channel that's been going since 2020. In fact, you could go back to there's August 2019. That's 5 years in the making. There was some consolidation there and up rising channel and then into a steeper rising channel, more gradient. But now testing the lower channel line of this channel to see if it holds. Also at a support level as well. And this is also around the 50%. There's the 50% of this fall. This is a log chart, so the 50% won't necessarily be smack in the middle, and it's finding that point, if you like, that point of decision around there as to where uranium goes. And of course, there's a lot of politics in uranium. Iron ore has fallen out of its. There's the big downtrend. Zoom in over here. Also a weekly chart. I did put that upper channel line in, or look. Half of the channel line. I haven't put the rest in yet, just seeing what plays out, because it broke out of it and it's come down to support now in that mid to high 90 support zone. That has been a strong support zone for quite some time now. Resistance up until this point, a bit of support, but this is going back to 2020. So some 4.5 years, that's been a strong support zone. If it falls below that, then it could go a lot lower. And of course, that goes into the iron ore stocks. Last, thermal coal. Thermal coal looks like it's forming a long-term base here. The longer this base goes on, provided it is a base, how will we know it's a base and not a resistance, a big wide resistance zone, will be which way the price jumps out of this when it eventually does. So I have no problem with a long base forming and then seeing where it goes. If there's a breakout to the upside that continues, and these commodities do move quite quickly, as you can see, and quite steep, but it's now at resistance. And if it's going to take longer for this base to form, which and you can read this into, sure, we're looking at coal now. You can read this into any price action on any chart. Is that the longer it takes, the stronger that base will become for future support or resistance, depending which way it goes. Right, that's it for today. I'll just go back to the S&P and just finish up with a theme. The theme is confusion in the market. There are slightly more, looking at breadth and sentiment indicators, slightly more that are favoring the risk-off scenario, i.e. a bit of weakness coming up in equity markets. But there are also some risk-on sentiment indicators there. I can't think there were any breadth of market indicators that supported the risk on, but certainly in the small caps, the mid cap, the S&P 500 they are not showing the weakness yet that you would find that you would get in a typically totally risk off market. So let's wait and see what happens to the price action. The story will unfold as we go. Look at the support zones that I have on these charts. You can download this into your instance of Beyond Charts. And just keep an eye on those support zones if you just want to, if you like, provide context and perspective within which, like I did last week, in the really bigger picture context and perspective of the secular bull market, because that overrides everything. And along the way, we want to be invested in secular bull markets. So we want to have a mindset of one that is that we are optimistic for the future in the secular bull market, because when you get into secular bear market, it'll be a lot tougher. But at the same time, we don't want to talk ourselves out of doing trades, and that means we ultimately go back to being a mechanical trader and following and trusting the market, the bigger picture, the macro picture, trusting your system and your edge that you're using to execute with and to execute flawlessly with, and ultimately to trust yourself that you are going to do this with discipline if you still need it, or just effortlessly if you believe that you've got to where you should be as a mechanical trader, as an active trader and investor. Right, I'll finish it there. There are no questions, and you can always ask questions where we post the video. And until then, until next time, I wish you consistent, objective, and peaceful active investing.